Testing 1 2 3 testing. We're doing a sound check. Right, testing. Okay. Right. Okay, so good evening everyone. So today we are doing a bit of a different, I think because Martin has a bit tired with something on, so today purely I will just be presenting for the topic for today, which is the moving average. Okay, unfortunately I may not be able to get Zach in because of some technical issues, so the stocks for tonight, usually reviewed by Zach, will be postponed to tomorrow. Okay, so for today it's just purely on the moving average. We're going to talk about moving average, and yeah, so we will start in a short while today. Okay, so hi Ling Ling, hi Dr. Derek, hi everyone. So hope you all had a good lunch. Sorry, good dinner today. Sorry, lunch pula. I think today the market is quite interesting, right? We got a lot of technical issues because of the one silly move by the US side there. I think the US CBP kind of like harping. I find it's an old issue. They kind of harping on it because of previously Top Glove was involved in that kind of was highlighted on that particular issue on that labor slavery and so on. But I think they're kind of like trying to divert temporarily the topic, or maybe there's some hidden agenda by the US. We're not sure, but yeah, it really does affect our stock market for today. So apa nama ni, we just see how it goes for the next 2 weeks time. That according to the report, they're giving a 2 weeks lead time, so we see how it goes from here. Yeah. Okay. So hi, assalamualaikum, salam. Alright, so today I'll be doing a presentation on moving average. Okay, I'll be explaining about the 3 classical moving average method used by the top hedge fund manager. Okay, and this will be one of the many series to come on topics related to technical analysis tool. Okay, I think for those of our members who attended the weekly member talk, alright, I did talk a bit on the moving average, but today we'll just cover it the whole 3 classical methods. Okay, and after that we end it after that. All right, just to bear in mind, there'll be no stock review for tonight because of some technical issues that we have faced. So for the next coming stock review will be in tomorrow night, okay, by Zach. Right, so before we begin, I would like to briefly introduce you to a profile of one of the most professional trader. Okay, and his name is Victor Niederhoffer. Okay, just put here, Victor Niederhoffer. Right, so he's a prolific hedge fund manager. Right, he's a champion squash player. This is according to the biodata that I get. All right, professional prolific hedge fund manager, a champion squash player, a best-selling author, and also is known as the father of statistical arbitrage and market microstructure studies in the field of statistics. Okay, his field of studies is in statistics. He was a professor. He taught and he lectured in the field of statistics. Okay, and you can say that he is somewhat like a polymath. Polymath means someone who has a knowledge in a lot of subjects, a lot of different fields there. Okay, so Niederhoffer we can say that somewhat is around there, right? And he was a George Soros partner and handled all of his funds on fixed income and also on the forex market from 1982 to 1990, so around 8 years. And George Soros held Niederhoffer with high regards, that he later on sent his son to go to work with Niederhoffer and to learn how to trade from Niederhoffer himself. Okay, so that kind of a level of Niederhoffer he is. Okay, and he managed funds such as the Niederhoffer Investment, which was founded in 1965, that generates around 35% per annum return since its inception in 1965 until 1997, where the company bet on the wrong side of the market during the Asian financial crisis in 1997 and eventually went bankrupt from there. Okay, and in 1998, the following year, he managed to raise funds by mortgaging his house and sell some of his assets, and he starts to trade again on his own until in 2002, where he manages his offshore clients' funds via the fund called Matador Fund, and this fund generates around 50%, which is this fund generates 50% per annum on compounded basis, and with worst performing in 2004, that gives him a return of 40%. So can you imagine that consistently he's been making 50% returns year after year, okay, and the worst performance he has was just one time where it gives him 40% return. So that speaks about this man himself. Okay, the fund was generating income until it got caught in the subprime mortgage crisis in 2007 and eventually have to tutup kedai already. Okay, so we can say that Niederhoffer is quite similar. It's like a modern day trader of Jesse Livermore. Okay, where they win big all the time, and at the same time they also lose big and give everything back to the market as well. Okay, so Niederhoffer wrote this one book called The Education of a Speculator. Okay, The Education of a Speculator, where it was first published in 1998, and the book gives us a glimpse into his trading style, his state of mind and soul while doing his trade, as well as his trading strategies. Okay, so you can say that the book is somewhat like his trading journal lah. Okay, you can see how his thought process is when he makes the trade and so on. And what is interesting about this book is that he did mention about Bank Negara Malaysia, our Bank Negara, you know, and it was in 1995 when he made a trade. He was trading forex, and what he did is that at the time he was betting that the dollar will become cheaper in exchange to the Japanese yen. He was actually shorting the US dollar against the yen, and you know, at that point of time the market was not moving in his favor, and it was causing him very emotional, and he was very nervous, and to calm himself he listens to those like classical music. This is the statement from the book, I'm just paraphrasing. He listened to classical music, he asked his wife to make him some tea, you know, just to calm himself down. And well, you may ask, why such a professional trader, you know, can be so emotional, you know, and so nervous? And why not? Because you are betting a big size of amount, and at that time he's shorting around 340 million US dollar or USD against the Japanese yen. So there's a lot of money there on the line there already. Okay, and he was hoping that Bank Negara can turn things around in his favor. And this is what he wrote inside the book there. Okay, he says that my only hope is the Bank Negara, the terrible central bank of Malaysia. And Bank Negara is like a pirate. It trades violently and takes no prisoners. Okay, and if they call up all 50 banks in their network at the same time and sell the dollar, I may be able to take my line back with dignity. So I did a bit of research based on the pricing that he gave, and I go back all the way until the year 1995, where this is somewhere around this pricing here where he made the short trade here. Okay, unfortunately what happened is that he was in the money after that. On paper he was like, okay, he's already like a couple of millions inside there already, and he just away for a short while to make a phone call to his wife to say that, hey, I'll be coming down in 2 weeks time and see you there. Then that's just it. And when he comes back to look at his monitor, and you know, the shark starts to come in to buy, and his profits become lesser and lesser, and he just straight away immediately cut. Of course he managed to get some profit lah, although not in the millions, but still some profit there. And the next day what happened is the price just went up. Okay, the dollar just strengthened against the Japanese yen, as we can see it is one widespread bar here. Okay, right. So yeah, goes to show that this is quite an interesting book to read. Okay, if you want, you can just buy it online, you know, and you can read it on your leisure time. Okay, so now we will go next to our topic. Okay, which is topic of the day, which is the moving average. All right, just bring it down here. Okay, just make it smaller a bit. All right. Okay, So moving averages. So perhaps the most popular technical tool, technical indicators used by the technical analysts is the moving average, right? And in the world of statistics, moving average is used to analyze data points by creating a series of averages of different subsets of the full data set. In the financial markets, right, it is used to smooth out the price data by creating a constantly updated average price. In other words, it helps to refine the price movement by filtering out the noise that is made by the random price movement. Okay, so moving average was first introduced in the world of academia in 1901, okay, through a published thesis by R.H. Hooker. He's a mathematician in the US, right? And at that time, the phrase moving average was not was not known at that time. What they used at the time was instantaneous averages, okay? And the phrase moving average was only used later in 1901 by Yule when describing the mathematician's work, right? And so from there on until now, what we use to call is moving averages lah, right? And there are many types of moving averages, but the most three well-known, that is what we always go through. I believe most of you who have just started for trading, you will have seen or you have heard about it, is that these three well-known moving averages, which is the simple moving average or SMA, the exponential moving average, which is EMA, and the weighted moving average, which is WMA. And normally, out of these three moving averages, the most widely used by the technical analysis is the simple moving average, all right, and also the exponential moving average. Okay, so we go on to the next slide here, and now we can see here is the formula for the moving average. Okay, so generally, moving average is calculated by adding the figures in a specified time frame and average it out by the total count in the specified time frame. So this time frame that we are referring to is usually determined by the user. So it's like when you see in your indicator in TradingView, you have there like you press like 9, you have like 14, 15 and 20. So those are the time frame, the specified time frame that you want to be shown or reflected in the moving average. Okay, so for example, if let's say the user sets the specified time frame at 9, for example, so the indicator will total up the closing price figures over the past 9 days and then average it out by 9. Okay, and you will have that figure, then it will appear there. Okay, so the same principle applies if you put in 20, 40, 50 and so on. Okay, so different moving averages will have different formula to use in the calculation, but the general principle still applies, which is to average out based on a specified time frame. Alright, so we have here like SMAs here, okay, simple moving average, which I've explained earlier on. Okay, so and then we have here also the exponential moving average. This one here, exponential moving average. This is weightage moving average. Right. So exponential moving average is a bit different compared to simple moving average in the sense that it gives more weightage towards the later pricing. Okay, it gives more weightage to the recent days or the recent pricing, and therefore the moving average line is more sensitive or more responsive to the latest price changes. Okay, for WMA, all right, I'm not very familiar of this because personally I'm more used to the simple moving average. Okay, but I think WMA, if I'm not mistaken, not many people will use WMA, especially for a trader. All right, so because for like us, like a trade VSA practitioner, what we normally use is the simple moving average. Okay, but the main purpose for moving average out for all of it, it still applies, which is to mitigate or to reduce the random short-term price fluctuations of the stock or futures market or whatever financial markets, all right, over a specified time frame. Okay, then go to the next one, which is the pros and cons. Okay, like every indicators, they always have a pros and cons. Okay, so we go to the pros first, which we have around 4 inside there. Alright, so number 1 is it smoothen out the trading noise. Right, when we look at the chart, especially on the bar, We see is like the long or the topping tail or the bottoming tail, you know, and then the wide or the narrow spread of the body of the candlestick, and the price capping, either it's capped up or it's capped down. And then there's the price movement that move according to market stages, which Zach always talk about in during the live FP that he done. Okay, so this is what we call the trading noises. Okay, and as explained earlier, moving average rule is to mitigate or smoothen out these noises into what we call a nice moving flow. Right, which I will show you later on in the next couple of slides later. Right, and then number 2, it is for a trend indicating tool. It's good for trend indicating tool because as it smoothen out the noise, moving average is also a great tool to identify trending price movement, i.e. whether the price is on an uptrend or is it going to go or on the downtrend. Okay, and for example, when market is in an uptrend or at the beginning, price will be above the moving average. Okay, and when we see two moving averages starts to open up, which what we call the opening of the railway track, which we taught also in the master class, it is a signal that tells us that the trend is strong. Okay, I will show you on later in the couple of slides. We have some examples and you will have a better understanding on that. Okay, so a strong railway track, okay, signal to us that the trend is strong and the price has the potential to move further in that particular direction, whether it is on the uptrend or is it on a downtrend. Right. The third one is it allows you to identify the support, the resistance, and the potential entry and exit. Potential entry and exit. It's not the signal for you to go in, it's just a potential entry and exit. Okay, and why is that? It's because that when price is trending on the railway track, okay, and the railway track has opened, this allows us to identify the potential support and resistance as well as the potential entry and exit. And as price is moving along the trend, there will still be fluctuations along the way. Okay, and these fluctuations are the one that will tell us where the potential point is. You can just line up your support and resistance there. Okay, again I will show you in the next slide when we talk about these 3 classical strategies move. Right, and number 4 is that it can be used for backtesting, as with any other indicators that you want to use like MACD or RSI. Okay, you will use it to backtest and to see the effectiveness or the probability of you getting a good trade. Okay, because as you backtest the strategy together with moving averages, you will find that moving averages will work well in determining again the trend, the support, resistance, as well as potential entry and exit. Right, and now, like all other indicators also, it has its downside as well. Okay, and what is it? Is number 1, because it is a lagging indicator. Okay, so therefore it's considered as a it is the outcome of moving average is quite later compared to price and volume. Okay, because main reason is because that it uses historical price of specified time frame. Right, remember when we said that the specified time frame, if you put in 9 days, you put in 9, it will go and calculate historical of 9 days behind. Okay, if you put 20, it will calculate the past 20 days. Okay, so it based on the previous or historical price, okay, to determine the current average. That's for moving average. So that's why you can base entirely your strategy or using moving average alone. Alright, but if you couple it with the main indicator, which is price and volume itself, then yes, you will have an edge on that. Okay. Number 2 will be the occurrence of false signals, especially in the subway market. This is very true, especially if you are trading futures market. I trade futures. Okay, I'm a futures coach for Trade BSA, so therefore I can confirm that this is always true. Okay, when the MA is moving, when the market is moving sideways and you have the MA just like intertwined. Okay, because they will have a tendency. Because when the price moving sideways, when the market moving sideways, the tendency for it to give signals are very high, and this is where you get slapped by the market left and right. You know, it's like you think it's going to break the support, but end up it will turn, and you go for a short, but eventually the price will turn the other way around, and you hit your cut loss and so on. And same goes when it tries to break the resistance, you go for long, but the price turn the other way around and you get hit as well. Okay, so that is why by looking at the market stages, you will know when to get in, you will know when to exit, and you will know when not to get in. Okay, these three is very important, right? And last but not least, because it is a lagging indicator, so it is unable to predict the market turning points. Okay, so that's why when you see like moving averages, if you, I believe most of you who have who have been trading or investing for quite some time already would have seen that when the price starts to move first, the indicator haven't starts moving yet. Okay, only when the price starts to either dip or fly, then only you will see the indicator will starts to make to the move towards that particular direction, right? Okay, so this is the pros and the cons. Okay, so next we will go on the pairing of the moving averages. Okay, the commonly used pairing. This is something like for those who go for like wine pairing, you will need to pair the wine with certain foods and everything. Okay, or food pairing, for example, what food will just go well with the other food. Okay, so in this kind of pairing, usually for moving averages, the commonly used one will be the 9 and 14, which is commonly used for those who are doing intraday or those who are doing forex trading. Okay, 2040 will be those who are using for short-term trading and also great as a reference point for the pullback method. All right, and also we have around 50 and 200, which is used for the mid to long term trading, and usually this 50 to 200 is used more for like for investment purposes. Okay, so these are just a commonly used. Of course, outside there's a lot of people who have like different variation. Again, these are just a guideline. If some of you may have your own indicators that works to your trading strategies, then yes, that will go ahead with it. Okay, but what I'm saying here is just a general guideline that most commonly used outside there. Okay, so based on this moving average pairings, we can see that the smaller the length input, okay, the numbers there, the smaller the numbers there, the more sensitive the moving average will react towards the price movement. So normally shorter length is used for short-term trading, while longer length is used for long-term trading, as we can see from there, right? 9 to 14 is for intraday, 50 to 200 is more for like investment. And the length of moving average can be used on any time frame, okay? Like 914 you can use in like 50-minute chart, 3-minute charts, or even like a daily chart or weekly chart. It doesn't matter, because what the system will calculate is just based on the number of price bars there, historical price bars there. So it is immaterial to like, oh, the number of minutes, it will just need to do another formula again. No, it's just based on that simplified, based on what time frame you select, then they will just recalculate from there. Okay, the wonders of technology that we have here, right? So the length of MA, again, as I said, it can apply to any time frame, and it is up to the user to determine which one that works best for them, which of course ties back to your trading strategy. If you're going for a short-term trading, then you go for the 914. And if you go for like a longer period of time, maybe like 50 to 200, or maybe if you find that 50 to 100 it works well for me, for my trading style, then by all means just go ahead, right? Okay, so next we will touch on the three classical moving average methods, all right, and how, which also means that how are you going to use the moving average. So first we have here is the strategy number one, which is follow the line. Okay, so we have here the one here which is follow the line, follow the trend line basically. Okay, which means that what you will see by following the trend line is that the price is moving either above or below the moving averages. Okay, so the price will follow accordingly to the moving averages. All right, I will show you later in the schematic charts. And then the railway track, this is what I mentioned, that the 2MA moving along in the same direction, forming a railway track, right? If the railway track starts to open, which means that the potential direction for that trade is starting, and it's going to be very strong there. Okay, it's the beginning of it. But once you see the railway track starts to close, right, which means that the potential trade reversal is coming soon. Okay, and then the third one will be that how much price move away from MA, it will eventually come down to close near the MA. So as long as it follows along the trend line, no matter how far it goes, it will still come back nearer to the trend line. Okay, so as we discussed in the previous mini classes that some of you might have attended, right, the trend line is very important because it helps a technical analyst to determine the trend in the chart, right? So if I can give an analogy, your trend line is something like your car headlights. So imagine that you are driving in the middle of the night, where the market is, where the entire scenery, the place is very dark and so on. So there's no street lights available, so you just switch on your headlights, okay, which will allow you to see where you are going, the direction in the dark nights, right? And without your headlights, you will be, of course, bound to get into an accident or crash out by hitting the road divider, or incoming vehicle. So a trend line is like your car headlights, right? So as we can see, the next one here, trend line, this is an uptrend. This is schematic chart here. We can see this is 20 and 40 MA here, where we can see the price, the line, average line, moving average line here intertwine and starts to go up here. And we can see from here is that the price, the railway track starts to make an opening here. Okay, when it starts to make opening, sorry, it's a bit ugly here. Let me just write it, circle it better. You can see here, this part here, the railway track starts to open, and then slowly it becomes more and more prominent. You can see, like, okay, it starts to make the railway track there. And when this railway track starts to open and form like this, then you know the trend is going very strong here. Okay. Likewise, if we see that when the price on the other side, we can see like a downtrend. Let me just clear this. Okay. See the price is on the downtrend here. Okay, also we can see the closing of the MA here, the closing of the MA. Let's say, for example, this price is on the uptrend. Okay, it was on the uptrend. Then we can see here that the MA starts to close, which means that the price will, the trend is starting to reverse. It's going to be on the other trend. In this case, it will be a downtrend. And we can see as the trend starts to close, we can see the price already starts to move down already, okay, because price is the leading indicator. And then eventually when we see the price starts to open, MA starts to open here, that's where it means that the downtrend will be very strong. So in this case, the downtrend occurs and the price starts to move down, lower and lower, okay? Right, so we can see on the next chart here is examples, alright, of the trend line. The trend line is up. You can see the railway track starts to move, and we can see the price is above the 20 MA here, starts to hug and move, and it's on top of the 20 MA. This gray line here is 20, this purple cut line here is 40 MA here, okay, and the price move up all the way. Okay. Same goes when we see the price is on a downtrend. Okay, when the price is on a downtrend, sorry. This is another example of an uptrend here as well. Okay, so if you see, like, there's one here which is like sideways move here. Okay, so you can see, like, we will not sure if, let's say, you based on the trend, when it's sideways move, you can't determine the trend yet. But if the price starts to move above, and we can see the railway track starts to open, price above the 20 MA, and starts to move along the trend here. You can see railway track, so it means that the price will start to move in that particular direction, right? The same chart here, but further on later, so we can see the price went down. Okay, so the price went down, okay, and we can see the railway track. Here is the closing, and here is the opening. So it means it says here that this trend is not going up anymore, not possible to go up, it's going to come down, and we see the railway track here starts to open, and then the price is already down already, obviously, and we can see that the price will come down all the way, right? You can see on the this chart here, you can see no matter how far the price move away from the 20 from the moving average, it will still come back down, go up, back up, come back down, up, and then this is moving sideways. Normally we would want to see schematically that I draw there is that the price will move like in this direction, okay? sometimes the price can move sideways and wait until the 20 MA reaches this price here before it starts to move up. Okay, so schematically we can understand it's like that, but the reality is the price sometimes may move sideways here. Okay, right. So next what we have here, what we have here is strategy number 2 is using the moving average as the support and resistance. Okay, obviously it speaks for itself. You can use the moving average can act as a support and resistance, and is famously used by most school of thoughts, including price action practitioners. Okay, and it also is good for you to time your entry when the price touch the moving averages. The reason is because the risk is minimal as the entry is during the rebound point. Okay, and of course you can use that also to see if the price breaks through the first moving average, the second moving average would need to act as a last line of defense. If it breaks through the second moving average, then definitely the price will just all the way will go on the opposite side of the trend. It means we have the reversal of the trend already. Okay, so we go on to the schematic here. Based on the same schematic, but we can see here in this circle here, this is where the price acts as the moving average here acts as the support line. Just imagine that you have a ball and you throw the ball onto the floor and the ball bounces back up. You throw it, it bounces back up. You throw it onto the floor, it bounces back up. So the ball is the price movement that we can see here. Okay, this is the price movement, and the floor is your 20 MA here. Okay, you got two floors here, 20 and 40 MA here. Okay, so as the price touches the first floor, it bounces back up. Okay, touches again and goes back up. And you see on the market stages is on the markup stage, and also we can see that the high here is higher than this high here, and this low here is higher than this low here. So it creates the higher high and higher low, and therefore price will make towards that particular trend, right? In this case, it's going on a uptrend. But when it penetrates to the first line, the second line, the 40 MA will become your last line of defense. So normally if it breaks here, price doesn't break above the first floor here, okay, then it will just come down and penetrate to this floor here, then definitely is a reversal of a trend already. Alright? Okay. So go to the schematic for a resistance. Also the same thing, we can see here, price will come down, touches here, come down, and touches here and come down. Okay, like the earlier one, okay, if you see the earlier one was that that is a inverse pullback. So that is a pullback, what we call a pullback. Okay, price will come up, will do a pullback, touches the 20 MA, goes up again, do another pullback. Right, so the same principle applies also in this particular chart as well. Okay, price will come down, do an inverse pullback, touches the 20 MA, come down and touch again. So this one, the analogy is something like when you throw the ball onto the ceiling, then it bounces back from the ceiling and comes down. So the ceiling, which is this moving average here, it acts as your floor, the resistance. Okay, so you're not able to penetrate through until it comes down. Alright, this is like a markdown stage until it moves like a sideways here. We can see it is a what you call this, accumulation stage. Alright, and it breaks through and starts to move, and we can see probably the MA will start to intertwine, okay, before the price starts to move up higher. Right? Okay, so next we see the example of an uptrend, okay, based on the support and resistance as I explained earlier. This is using the same charts, okay, right? So we can see that the price will go up, will come down again, then it will bounce back up, come down, bounce back up, come down, up, sideways, and up again. Okay, so every time when you enter around here, your risk is very low, because if anything that the market will start to turn and break through, at least you will suffer just a very small losses there, as compared if let's say you were to enter when the price is far away from the moving average. You enter somewhere around here, this is a bit too high of an entry here. Let's say this is around 2,300. Okay, you enter around somewhere this pricing here, and the price came down to 2290. So probably you will suffer around 10 points loss already. But if you were to enter somewhere around here, and it goes up here, you may have made already a profit of around 10 points there already. Okay, this is a futures market example. Yeah. Okay, so on another one which is uptrend as well, this one is quite prominent as well. You can see the price move up, came down to touch, go up again, come down to touch. You can see the low is, this low is higher than this low, and this high is higher than this high. And then the price move up and it moves sideways here. Okay, and then before eventually it starts to move up again. So this is another high. Then we have another low here, pull back, move up again until eventually it cannot move up any further, breaks through this 20 MA here, then usually a signal that the weakness is coming in, right? But if for price and volume user, okay, or for VSA practitioner, we would have seen that this is the weakness, right? And price not able to move above the high of this price here, came down, so we know already that weakness is coming in, and we already chabut by then around here. Okay, so another one is same chart pattern, but it's a bit later, where the price starts to come down and it touches back up here. You can use this as this is the support, right? Touches the support, came up, touches the support, then doesn't have the energy to go up further, and it starts to U-turn, break down, then comes up again and touches the support, which has now become the resistance. So it touches again, come down, touch for the second time again, and if it fails to break through, you know that the weakness is very strong there already. So therefore the price will just eventually starts to come down, move sideways a bit, and touches the 20 MA here. Okay, before it continues to go down further. This is usually a classic pattern. In the futures market, we can see, because futures market you can short. So if I take at this line here, this is the support here, right? And then when the price first hit around here, so I can just draw my line around here, and I know that this is where the support previously is, which has now price has penetrated through, going down, turn back up again and touches around here, which is testing the support, where has now become a resistance. Okay, so this is where you want to enter, you want to short, right? You don't want to short when the price already break down further. Okay, let's say you're a bit late and then you want to enter somewhere around here. Here you will get slapped definitely, because what we see is that the price will come down, will break through, and it always do a test back again. Means it will test back at this level here before it starts to make its move the other way around. Okay, same goes when the price here starts to move up, comes down. Okay, it always comes down to test at this level here. You can see somewhat around here. This is the support, this was the resistance, so it is break through the resistance and come to test the resistance, which has now become the support, before it starts to move back up. Okay, it's very classic pattern here for uptrend and for a downtrend here. Okay, right, and let me just clear this. Okay, and last but not least, we have the MA crossover. This is frankly speaking, I don't really much see on the MA crossover, because as I said, I'm more of the price and volume user, and using moving average is just to allow me to see the trend, whether it's uptrend, downtrend, or market moving sideways. But for some of the professional traders there, right, or those top hedge fund managers, they will use this signal as well, all right, which is the MA crossover. So what does MA crossover means is that it's a signal of potential change in a trend. Okay, and normally what happens is that when one MA cross over the other MA with price either above or below the moving average. And usually the two most famous entry that they will look at is either the golden cross, which is the short-term MA cross above the longer-term MA, or we have the death cross, which is the shorter-term MA cross below the longer-term MA. So we'll show you in the next schematic chart here. This is what we have here, the golden cross, which is an uptrend, right? And this is what we call the golden cross, when these two MA, right, when the shorter MA here, right, let's change this, and the shorter MA here, right, it goes and move close to close above the longer MA here, right? And remember when we see the railway track opening, okay, right, and the price is above the shorter term MA here, and that's where the golden cross and the price will eventually go up, right? So you can say, I think similarly, you can say that golden cross is something like the railway track for an uptrend like that, okay? But just that golden cross means the thing starts to cross. But for us, we see that when the railway track starts to open, it's already a strong signal that the trend is going to go up in this particular uptrend lah, right? Then we see the other one, which is the death cross, which is the downtrend. Then we can see that the price move up and comes down, and the shorter term MA goes below the longer term MA here, and we have the cross here happening. So this is the death cross, means mati already lah, mati kodasai already. The price will starts to come down. Okay, price starts to come down, reverse back up, touch and come down. So from this MA, you can see there is a lot of these three strategies you can combine together. You know, you can use it as a confirmation for you to know the trend. You can use it to time your entry. You know, where it comes down near the moving averages, that's where you make the entry or exit. Okay, and then at the same time, when you see the MA starts to cross, or what we call the railway track here starts to open, okay, it's good also to know that this is the trend is coming in already. Okay, but one thing for sure for moving average is not very good when the price is moving sideways, right? As we can see in this uptrend example here, where we see in your trading view, if you're using trading view, you can set, there's one that we will, what they call, you search for the indicator which is MA cross, okay, and you just look for the one which is you do not use the generic one MA inside it, okay, you just find the one which is created by other users, okay, and then you use that, because the reason being that inside there they don't have the cross what you call the setting inside there, right? It's just that you set your no, they have the cross setting, but you can't set your time frame for your moving average, okay? So like in this case, we have the cross here, okay, a few crosses here, and you can see what happened is that this is a market moving sideways. Okay, market moving sideways, definitely you will not be able to get a good trade from here, all right? But of course, you can use based on the support and resistance, of course not using the MA, but based on the chart itself, using the support resistance, you can just buy somewhere here and you can just sell somewhere here. Problem is if you short somewhere here and then the price just hang on somewhere here, and you know, you just get too tired of waiting and you may just scratch your trade a bit too early for that matter. Okay, and sometimes you may have like the cross here. If you can see here, the cross doesn't come out where this MA cross here. So you have to see sometimes the price when it, let's say at this bar here, okay, at this bar here, where the MA is haven't crossed yet, okay, but comes to the next bar, the MA already crossed and starts to make a bit of an opening. So the cross will come out at this juncture here, okay, but most of the time it will be just where the price crossing here, right? So we can see from here is that this is the uptrend. So when we have the MA cross over here, okay, this is quite a strong uptrend move, because we can see based on this chart here, we have the previous support line, okay, and we can see that when the price opened here on the afternoon session, it gapped down a bit, moved sideways, then after that price break through the resistance, which has now become the support, cross over here already, all right, and the price eventually just starts to move up. So you will ride with the trend there already. Okay, if you entered somewhere around here, then the price will move around here. Here, mostly people will get gabra, takut, they will just exit because they see that this bar itself, although it's very small, but it's just that, you know, smart money will play with your emotions definitely, and you will just get, oh, price coming out, you just exit from there. You just maybe earn like around 3 or 4 points, and then when the price starts to move up, you just end up biting your fingernails, because you just like, I should have waited and, you know, let the price to move up. Okay, so always you always see that when the price is still hanging above here but being supported, then you do not exit the trade too early lah, all right, and you follow the trend. If you ride the trend, it should be no problem. I would say around 90% of the time, if you follow the trend, you will be able to get a good income, but provided if you entered a bit early, or at in the beginning or somewhere a bit halfway through there. Okay, but if you enter a bit too late, if the price is too high and you want to enter, I would suggest you not enter at this timing, because at this area here it will be too late for you. If you entered somewhere around here or somewhere around here, you know, in between, that is okay. But somewhere around here, price may bound to just like, you know, make a U-turn or move sideways, and you just end up suffering a small losses or maybe a small profit, but that's not what you want in making a trade, right? Okay. So the next example we have here, which is on a downtrend, again we can see the price moving sideways here. Okay, price moving around sideways here, and we can see this crosses around the same line here. This is the sideways move here. Definitely, if you were able to trade, you sell here and then you buy around here. If you have this kind of a nice pattern, you'll be nice also. But you do not want like the price move up sideways a bit and move up and come down, so there is a bit no use for you to make the trade. Okay, so but if it comes down, right, let's see, you enter somewhere around here. Here is quite nice because we can see that the MA cross, okay, and then we can see on the right side the railway track starts to open. Here the railway track starts to close and price already comes down around here, right? So you can enter somewhere around here as well and just follow the trend here. It's just, but the problem, the one thing about this is that it's just a waiting time, how long you can wait, you know, depending on your moving averages. Like in this chart and the chart before that I showed you, is based on the 9 and 14 moving average, which means because futures we are trading based on 3-minute chart. In this chart, it is a 3-minute chart, and we want to be in and out quite fast. Okay, so 9 and 14, this MA here that we are using, but normally I would use around 20 and 40 because I want to see a bit of a more stability in terms of the strategies that I use inside there. Okay, so if you're entered not here but you want to enter a bit later, can, so somewhere around here where the price already break through the support around here, okay, then you can enter. But if you enter somewhere here, be prepared that the price may want to move up again just to test again the support here, that which has become the resistance. It's always the classical case where it will always do a test here. So end up most of the members that I've encountered, I've talked to, they've talked to me as well, saying that Alif, when I come here, the price I entered here, but the price will go up here and I will hit my stop loss. And I said, yes, you need to enter where when the price comes up somewhere near here, okay, then that's where you make the entry, and the price when it starts to move, and at least you can have some profit inside there as well. Okay, right, and we have one here which is the sideways move, right, which is the sideways move here. We can see that the price moving sideways. This is quite long, this on the 15, right until the closing, and you can see the price moving sideways around here. So there's not much activity for you to do. Okay, it's around 30 points, but you know, if you get caught somewhere around here, then there's not much for you to trade. Let's say you were to short around here, imagine how long does it take for you to go and reach at this side here. Let's say here you enter at around 2:45 and you're able to exit around 4 o'clock. That's quite a long wait there. Alright, if you're using only purely on moving averages. Okay, so moving averages on the sideways move is how should I put it, I would say a major big no-no lah, basically, for a sideways move. Yeah, okay, so we have come a bit to the end of it here. Let me just clear up this thing. Okay, so in summary, right, so in summary, moving average can be a good tool to guide you in your trading. The use of which type of moving average also depends on each individual preference and trading style. So the most important thing about moving average is that it can be used as a trend referral. Okay, so you trade with the trend, right? Because we always emphasize in the masterclass and also to our members as well that when you see a trend forming, always follow the trend. You never go against the trend, because you just end up killing your trade already. You're just like giving charity to the stock market or to the futures market, which we don't want, right? And of course, definitely we do not want to be like what Niederhoffer wrote in his book, alright, about how Bank Negara who always go against the trend and end up losing billions of dollars. Okay, I think it's inside Wikipedia also stated there, like Bank Negara lost $10 billion because of the forex trading, right? So you do not want to end up like that. Okay, that's not trading, that's already gambling. And being a wise and intelligent trader and investor, we want to trade with the edge on our side. We do not want to end up being a gambler. If gambling, might as well just go to Genting and do a gambling there, okay? Because there's no edge towards that side there. And of course, if you combine your moving average with a volume spread analysis or VSA, you have a better edge in trading, right? And definitely price and volume is a real-time leading indicator, and combine it with other secondary tools like maybe your moving average, or you want to combine with your RSI or MACD, and it can give you a better advantage. So we always tell our members, always you trade with an edge on your side and not with an edge, okay? So with that, I apologize because today we have some bit of technical issues, so we are not able to do the usual stock market review by Zach, okay? But you can get back to us tomorrow at the same time around 9:30, and tomorrow morning Martin will have the Smart Robbie talk show around 10:15, okay? And for our members, we have same timing around 2:15 tomorrow Friday, so catch us on that. And of course, we have the total trader as well. I think there's one topic about total trader versus a volume spread trader, not mistaken. One of the topics there, okay, on this Saturday. So please get your tickets there. It's on the Trade BSA notice board, if I'm not mistaken. You just click on the link there, and and get your tickets there to join us as well, okay? Right, and till then, so that's the end of my today's sharing session, and I will see you again next week for another sharing session again. Until then, stay safe and take care.